Hello, Veena. Sorry, because there was some computer update in happening. I had to wait for a little bit of time. But
No problem, no problem.
yeah, now it's all right. Yeah.
Okay.
So I want to start with the transfer pricing first of all, and then
Right.
hopefully we will look at another mock. But before we go into the transfer pricing, what is transfer pricing? We know transfer pricing is between the inside. It can be between a subsidiary and a parent or two subsidiaries. I mean, it's internally arranged price. It can be between two divisions. Now, in our Mentine, if you look at, we have the one always for a film, there is a company which produces the film. So all the costs are incurred by that production company, and obviously the owning company is the finance company. So most likely the production company will have to transfer the product or sell the product to the finance company. That's the first pricing. So the production company will have to decide which way, what is the method that they will approach to price the product for the financing company. Where the financing company is the company that is giving all the finances. Right? So that's one thing. Then after that, once the financing company get the whole film, they have to decide at what price they are going to give it to that distribution company. Distribution company is one common company for all the films. So every film company, every finance film company will have to decide at what price they are going to look at the thing. So you can see transfer pricing somewhat involved in this process. So for that purpose, let's look at the background theory about the transfer pricing.
Right.
Basically, the organizations are divisionalized depending on whether it's an investment center or whether it's a profit center, whatever it may be. If you look at all our companies, the three subsidiaries, the main parent company, and also the finance company, and also the production company and the distribution company, all will be investment centers. They are called investment centers because they are responsible for the profit and also the return on capital employed.
Right.
So each division, each subsidiary will take its own decisions. They are given authority to take decisions at their subsidiary level. Obviously, each board will have a separate set of directors. They will look at from that one. But of course, they will apply some control from the head office. Head office in this case will be the main company.
Okay.
Right? So that's how the things will work out here. So let's look at the purpose why we decentralize, why we want to have, because we probably want to give more autonomy to the local areas, production company to decide at what price they should transfer it to the finance company, and also so that they can keep their cost. Now, if you look at the transfer pricing, they can transfer it at the cost. Right? Whatever the cost, that's the minimum they will transfer it at the cost. If they transfer it at the cost, obviously they are not, the production company is not going to make a profit out of it, but that may be one way to go. Or otherwise they might be transferring at cost plus a particular markup.
Right.
Cost plus a particular markup. Now if that is the case, if that is the scenario of the transfer pricing, surely it has no incentive for the production company to save the cost. Because if the production company spent 100,000, they can transfer it 100,000 plus 20%, 120,000. So what is their profit? 20,000. Right? If the production company spends 150,000, they can transfer it at 150,000 plus 20%, 180,000.
Yeah.
Right? So there is no incentive for them to reduce the cost if you transfer it at the actual production cost.
Mm-hmm.
The other end is to transfer it at the market price. The film owning company will say, okay, this is the price we are going to pay. You produce the film at whatever the price. So the market price may be, shall we say 200, or they fix the price and they will say, we will buy the film from you at 200,000. So in that case, the production company has all the incentive to reduce as much as possible the cost, because they know they can sell it at 200. If they spend 150, they will have only a 50,000 profit. If they think 120, they will have 80,000 profit. Why do we do all these things? Because we want to motivate people to improve performance and profitability. So by fixing up a market price and telling the production company, this is what we are going to pay, they will have all the incentive to reduce their cost, produce the quality film that the finance company wants it. But at that moment, they will decide and they will make a profit, and the people in the production subsidiary might get a bonus out of that one. The other way is to negotiate the price. Negotiate the price. After doing, the production company will say, we want to transfer at 150. Our finance company will say, we don't want to spend 150, whatever. And there can be a lot of discussions happening, and there can be a lot of tension happening. Sometimes the people who have the more bargaining power will win over. That kind of a thing will be happening. And the idea is ultimately for us to distribute, to make a profit, because ultimately from the parent company's point of view, when you take the entire family, it does not matter, right? Because if we say 120 and 200 is the price, and finally the finance company can sell it to the distribution company, and distribution company can sell it to the outsiders. So ultimately what matters is initial cost, okay, 100. At what price is the distribution company sells? 250. Inside the group, we have made a profit of 150.
Okay.
Right? But how it is split between will make a difference, because, it can be finance company making 60, distribution company making 90, or production company making 40. So as far as the whole group is concerned, it does not matter. But between the divisions, there can be creating problems. So from the head office point of view, for them, it does not matter what the transfer pricing is for a particular thing like a film. But for some other matter, other product, they might have a concern, because if you overprice your product, ultimately, no one will buy. Say, for example, the production prices it at a high price, and finally the finance prices at a high price, give it to the distribution company find it with that kind of a cost, they can't sell it.
Okay.
They can't sell it. In that case, it's a total loss scenario, purely because of the internal pricing. Ultimately, the film is so highly priced, no one is prepared to buy the film. In that case, the head office might intervene and say, look here, you all are, making all sorts of crazy things. And that case, head office might decide to fix up prices or intervene. When that happens, the people can get demotivated. Right. Because the production, the finance, the head office might say, production, hey, you can't sell it anything more than 150. So production people might find, oh my God, we have spent 140, we have to sell it at 150, and we are only making 10,000, and it's not enough for our bonuses or whatever. So ideal situation is to allow negotiations to happen, but sometimes through the negotiation, you might find things not getting optimized, and there may be scenarios where ultimately the whole organization may be ending up with losses.
Okay.
Head office intervention is good where it's going to be damaging the organization interest, we will step in, alter the decision that have been made at profit center level, make new decisions for the profit centers level. However, the moment head office starts intervening, the autonomy is lost. The independence the people had is lost, and it can create lot of dissension, demotivation, etc. Particularly this happens when the divisions are responsible to make profit. Right? Otherwise, they will be not bothered. Because if ultimately if the whole group is going to get a profit share or something like that, then of course the people will not be bothered about who makes a profit, because they know whoever who makes the profit, all the people are going to equally share the profit. In that case, it's a different story. But the moment we have a scenario like where one company can make a profit, the other company is not making a profit, it's on the same field, all have contributed towards, and they might feel that they have been unfairly treated. So transfer pricing, there will be some interconnection. Some profit center will supply goods and services to others, like what we see here. When interdivisional trading take place, and therefore the pricing will have to be done, the price of the transfer price is what we call the transfer price. That is the internal price. So it is treated as an internal sale and an internal purchase. Whoever the producing, the production will sell it. It will be for them, it's an internal sale. Whoever who buys, it will be an internal purchase. And once you combine, of course, everything gets settled down. So once you combine the consolidated financial statements, you remember all these intercompany profits, losses, everything will get wiped off. Nothing will happen. So entire organization, no problem. The divisions or the subsidiaries, in this case, will have an issue to be sorted out. So the policy is ultimately, there is a cost at one end, there is a selling price, the ultimate selling price to the outsider at the other end. Between that, there is a profit, and that profit, how it is being split between two or more divisions. In this case, probably maybe production, finance, and distribution, 3 companies. So ideally, both divisions must benefit from the transaction if the sale is going to take place. Selling division will not agree to sell to another division unless it is profitable for the selling division to do. Now here you can see what's happening is here they don't have an external market. I mean the film company, the finance company, they can't sell it to an outside. Right? They have to sell it all to their internal distribution company. The production company cannot sell it to an outsider. So the normal transfer pricing principles of having market prices and whether there's external customer and what is the price the external customer will pay, what's the price the internal will pay, those things will not arise in this particular scenario. This scenario, all will be internal sales till the final distribution company sells to the outside. Only person who will be selling to the outsider will be the distribution company. So, so therefore, there is no market for the product, and there is no external market for the product, and there is no kind of a special price which they can get. So to that extent, the transfer price in here will be very simple. The transfer price in here will be to decide on the cost and a markup. Now, cost and a markup you can do on 2 ways. One, to wait for the actual cost 100 million and put up a 20 million, 20%, 20 million, transfer it at 120 million. But if you do that one, as I said, if that is the scenario, the people have no incentive to reduce the cost, because the more the cost, they will be getting more profit. The transferring company. Transferring company. Transferring company, the company that is receiving, will have lesser profits, because ultimately there is a market price. Right? Ultimately, distribution company cannot sell at whatever their price, they will have a market price. So the production company will be at a benefit if you say that cost plus actual cost plus markup. So what they do is mostly in this scenario, they fix up a standard cost, a
Okay.
predetermined cost. Predetermined cost, for example, for the film, they might say you can do it at 400 and transfer it at with a 20% margin, 480.
Okay.
400 plus the standard cost. Now, if they can produce at anything less than 400, right? Now you can see the production company will have a greater incentive to produce it at a lower price because now because based on the standard cost, the selling price is fixed at 480. So if they can produce 390, for example, they have an opportunity of making a 90 million profit internally.
Okay.
If they can make it 380, they have opportunity of making 100 million. If
100.
they exceed the standard cost and make it 420, they have opportunity of making only a 60 million profit. Can you see? So the ideal scenario here, if you want to make cost efficient, because in a film, you remember the three things what we discussed: cost, then quality, and then the delivery time.
Yeah.
Every film is a project: cost, quality, and delivery time. So when you look at from that angle, it will be ideal if you can set the standard price or set the transfer price based on standards. That will make the other people, the production people, to make it as lowest cost as possible. So this may be a question that can come up. If you were to set the transfer pricing, here there is no market price and external price and internal price and all that. The question will be whether we should set it on actual price, actual cost plus markup, or whether we should set on standard cost plus markup. If you set on actual cost plus markup, there is no incentive. In fact, there is a kind of a pushing towards cost increases, because the bigger the cost, you will have a bigger figure. 320% is 60, 220% is 40. So there is no incentive. So ultimately what happens is the production department will get a bigger profit. But overall, as a company, we will lose because we have spent 300 million, and because of that, the production department will get 60 million. It's all right. But end selling price will be 400, and altogether the company will be only having 100 million.
Yeah. Right? Okay.
But if the transfer price is set based on a standard price plus this thing, right? Then in that case, okay, we fix it at 250 plus 20% 300. They have all the incentive to make it 240. If they make it 240, and if the selling price is 400, the whole company will benefit because the company will get 160 profit.
Right.
So the ideal scenario in the Mentin situation will be to set the transfer price based on standard cost plus a markup, not the actual cost plus a markup. That's what probably your question will be.
Yeah. Okay.
Pricing decision, transfer pricing need to be established and agreed. They could be decided either locally or centrally, right? They could be imposed by head office. Really, they could be decided by commercial managers between the profit center manager. So in this scenario, I believe the ideal thing will be to pre-decide the transfer price. Pre-decide the transfer price and tell the finance company, hello, you will get at this price the product. And you will tell the production department, we are allowing you a 300 standard cost plus a 20%. So if you do it, you can transfer it at 360. Right?
Okay.
So if they can make it at 280, their division employees, the production company division employees will be more beneficial because they will have a 80 million profit to be distributed or to get the bonus or whatever it may be.
Right.
So that's the way they should be looking here. I don't think they should give any kind of a negotiation. The head office should intervene and decide initially at the very beginning, this is the transfer price. And once it is
Okay.
decided, once it is communicated, the production people will know that is the maximum they can transfer. So they have all the incentive to reduce the cost as much as possible and do it, and thereby they can maximize. From the group's point of view, it does not make a change, right? Because the group ultimately can sell it, the distribution can sell it at a particular price, whether the cost is 300 or 400 or 450, they can sell it only at 420. That's all.
Okay.
So that's what I can think of transfer pricing here. So interdivisional should take place with a broader company policy. So the company policy here should be to set the standard price early and to run. So selling division, if the selling division is given the choice between making a sale to an external customer or supply, now that will not arise here because the selling division has no option to sell the film to any other person other than the finance company. Because the finance company are the owners, they must produce and give the film to the finance company. And the finance company also has no other option rather than to sell it to the distribution company. Yeah.
Yeah.
So all the other things what we learned in normal transfer pricing will not apply in this case type. So that is why we have to be careful. That is why we have to be careful. We should not try to talk about all the transfer pricing, because what we must talk about is the transfer pricing, what is relevant to this scenario. So we should not be talking about whether we have external customer, all that. So the only external customer will be for the distribution company.
Yeah.
And for the distribution company, there is no internal customer. They only have they have many external customers. External customers will buy at the market price. It does not matter what the cost is, whether the cost is 400 or 500, they will buy at the market price. That's all.
Right.
So division should be allowed to sell externally rather than, so that will not happen here. So these things, this slide will not be relevant to us. In fact, we should not be talking about this in our case study.
Okay.
Because sometimes what happens is when we talk about the transfer price, we will go on talking about all the transfer pricing, which may not be relevant. So objective of transfer pricing is, this is very important, goal congruence. Ultimately, everyone, because we are judged by the performance, and therefore the pricing should be somewhat reasonable, good for the division and also as a company as a whole. So that's why I said, if you decide the transfer pricing based on a standard cost, that will be the best setup here. Performance measurement, we should have a way to measure the performance of each individual subsidiary. And you have to remember, it's not only the financials that matter. We remember in our P2, we learned something called balance scorecard. We must be remembering, we have to look at from the non-financial perspectives, things like the customer perspective, things like the internal business perspective, things like learning and innovation.
Right.
Plus the financials. So whenever we are going to set the performance, we should be looking from all those angles. Because if you just put financials, they will try to produce it at the lowest cost. The film may not be of any quality, and that may fail. So the film must be of quality, and also they must be encouraged to produce new innovative films. And for that purpose, the people must be trained. People must be sent for various training and etc. So if you are not going to measure purely on performance, they will not do any of those things, and on the long-term sustainability, the company will not do very well. And also the divisional autonomy. So basically, it allows the organization to manage on an autonomous basis, given tasks for each and every unit, in this case, the finance company, the distribution company, and also the production company. You remember, production company is 100% maintained owned, distribution company is 100% maintained owned, but the finance company, we have a external shareholder.
Yeah.
Right? It can be 60%, it can be 40%, it can be 30%, but we have some outsiders whom we call non-controlling interests. So
Yeah.
obviously that company will be very, very focused, concerned about making profit because there are outside investors. So they will be looking for their dividends and returns, etc. And therefore we have to ensure that they get a reasonable kind of a thing, and you have to set your pricing accordingly.
Okay.
If you try to, get the film at the cost and transfer it to at cost to the distribution company, that may even sound unethical, but definitely not commercial. Because when we have external shareholders, we have a responsibility to see that external shareholders are also properly rewarded, equally well rewarded.
Okay.
Right? Because the finance company can always, think, why should we declare dividends, right? We will transfer the cost to the distribution company. Let the distribution company make the maximum profit. So by doing that kind of a thing, they might deprive the external investor of getting his or her dividend.
Okay.
It may sound unethical. It may sound very short-sighted, because if you try to go on doing that one, of course you can make big profits because you are not giving 40% that part of that, right? You at cost you are transferring it to the distribution company. If you do that one, what will happen is in the long term you will never have any financial investors.
Okay.
Right? So you have to be careful when setting the transfer price from the finance to the distribution to ensure that the people who have invested externally will get a reasonable return. Also, sometimes the tax can come into play. In certain countries, production companies may be taxed at a different rate. Distribution companies may be taxed at a different rate. So if, say, for example, if the distribution companies are taxed at a lower rate, you will have all the incentive to make the maximum profit in the distribution company. Understand?
Okay.
Right? The production company, they might say you have to pay 30%. Let's put the other way about. They might say production company you have to pay 20% taxes, but distribution company they have to pay 30% taxes. So then you will have all the incentive to make the biggest profit in the production company. The production company you pay only 20%. Distribution company you have to pay 30%. So you will try to transfer the film at a very high price to the distribution company, and to maintain minimum profit in the distribution company, and to pay at the 30% tax rate little tax, and to pay at 20% tax rate more taxes.
Okay.
Right? But having said that one, you can't go on manipulating taxes like that. The authorities can come and say this transfer has not been done in a commercially accepted value, and therefore they can disregard and tax you based on the commercial value.
Okay.
So yeah, that's another objective we look on transfer pricing: divisional autonomy, and maintaining global tax liability. Yeah.
Okay.
So three bases for setting transfer price: market-based, cost-based, negotiated. Now for here, there is no market-based transfer pricing, because ultimately the product will be sold by the market, and therefore that is not a transfer price. It will be sold to the outsider, and that's not a transfer price. So here, even a negotiated transfer price may not be the right approach. The right approach will be cost-based. Cost-based also not on the actual cost, based on standard.
Predetermined cost. Yeah.
Predetermined cost.
Okay.
Market-based is generally when there's external market. Here we don't have external market. Film is produced exclusively for the finance company, and therefore you can't sell it to an external market. So cost-based transfer pricing, it can be marginal cost to the selling division, marginal cost plus a markup, full cost plus selling division, full cost plus markup. Here it will have to be full cost, because the production is only for one particular film. So there are no 100 films being produced. So every cost must be recovered in the production company because they have only one film and that's it. So the marginal cost will not apply here.
Okay.
Since standard or budgeted costs are known in advance, it can be transferred as it occurs. Actual costs are not known until if transfers are done as standard cost, the selling manager could be motivated to improve the profit by keeping the actual cost below the standard.
Yes.
This is what I mean. This is the slide that we can apply in this case. External market, we don't have external market here, so we don't need to worry about this one. Right? Here also this is not the imperfect market we don't have because we produce one film, one company and we sell that to our main distribution company. So decision making always will be, this is also not available because you will not be selling at variable prices because you have only one film, you want to recover the total cost. That's why. There is no surplus capacity here because you are producing one film, so no surplus capacity. So that also will not arise here. So actually in this case, the transfer pricing can be only happening in one way. One thing what we need to do is something called dual price. The dual price is all about you have a market and your people want to sell it at the market price and also other people don't want to buy it at the market price or that kind of a dispute scenario, you might able to introduce what we call dual price. For example, finance division says, the finance company says, we will not buy this film anything more than 300 million. Production department is telling, we will not sell this film anything more than 325 million. So there is a kind of a dispute. So what we can, the head office can intervene at that time. You can tell, okay, Mr. Production, you sell it at 325. So let's assume his cost is 250. He is going to sell it at 325. He will be very happy. He is making 75 million. But Mr. Finance is not prepared to buy it at 325. He is prepared to buy it at 300. So we will tell, okay, you show 300. You buy it at 300. Right? And you sell it to the distribution company 400 and make 100, it's all right. So the production company will show a 75 and this company will show 100, 175, but that 25, we will keep it in our head office books and we will, later on, we will transfer it because you keep both the managers happy. As far as the entire company is concerned, no problem because original the production company cost was 200. Ultimately, you sold it for 350. So entire group profit is 150. Only thing there was a dispute between how to share that one. So what we said was okay. You want to sell it, make it 125. You want to show 125, so take the 125. Other man wants to show he doesn't want to take it at 325 and sell it at 350. He wants to take it at 300 and sell it at 50 and show 50. So show. So production man will show 125. The distribution, the finance man will show 50, 125 plus 50. Both are very happy, 175. But from the company's point of view, it's only 150. That 25 that is in between, head office will keep it and write it off to the PL. That's what we call dual pricing, allowing both the managers to freely negotiate and do, but without upsetting the two managers, and then trying to head office intervening and setting off the balance. So that can be done. Whenever there's a big dispute, there may be a scenario saying that the production company is not prepared to come down on price and the finance company is not prepared to buy at that price. The solution is to introduce dual pricing.
Right.
So that's an area that you probably can work it out on this question. This is again, we have to look at all the costs in a film. Film, you remember, it goes for a fairly longer period, 7 to 8 years. So you consider the entire life cycle cost, and then we will look at the price. You might have the film going into foreign countries. In that case, the problem may be, particularly if you have a subsidiary or a company of your own in another part of the world, you might have because you remember this is a consolidated balance sheet. They may be even having foreign subsidiaries. We do not know anything, right? It's a global company. So if there's a foreign subsidiary, for example, in Europe, you produce a film and you want to sell that in Japan. Japan, maybe the tax rates are very high. In that case, what you might do is, you might sell it, because Japan, you don't want to pay a lot of taxes. You will transfer the film at a very high price. Very high price. Make the cost increase. And therefore, show little profit in Japan and pay little taxes in Japan. In your own country, you pay more taxes because your tax rate is lower, and therefore you transfer it at a higher price to Japan. So the selling price is very high, cost is low, and you will have a bigger profit and you will pay taxes accordingly. This is this can make, in a way, this is the way most of the multinational companies manipulate taxes. So say, for example, in your country, in this country, I think the B-land or something like that, you will pay more taxes. The B-land tax authorities will be very happy. But if the Japanese tax authorities come to know that what they have done is overpricing and paying little taxes, they will be very unhappy. So there are some guidelines given by OECD, Organization for Economic Cooperation and Development. They say transfer pricing should be adjusted using an arm's length transaction. You can't deliberately increase the price and transfer it. You must look at in the normal course of business. If you have produced a film like this, at what price will you sell it to Japan? And that should be the price. So if the price is normally 300 million, you can't make it 400 million, because then it's not an arm's length transaction. So arm's length transaction is price that would have been arrived by unrelated companies. So that's international pricing. That may be the scenario. So arm's length, basically we look at the comparable price and then we try to work it to that one. So this is simply about what we need to know about little bit about the transfer pricing.
Okay.
So I want to look at today a different kind of a mark. I have not, I think, shared this mark with you, but I'm going to now look at this particular mark. It is again on ethics, something like this. Right? I think I have not shared this one. It is it is about tax avoidance. So you are basically you get from your Anton Chan. Anton Chan, you remember, is your distribution director. Yeah. Tax avoidance by Santosh. I'm forwarding you an email from a journalist. It came via Eugene, who passed it to me. Eugene is, I think, one of the executive directors here. Some of the basic facts stated in the draft are correct. We do have an arrangement with our part-time tax consultant to refer many of our friends to her for tax consultants. Our tax consultant Jane, who is a CIMA qualified accountant, pays a commission for such referrals, and it is not shown in our maintained books, and we share amongst the executive board members, and we do not pay taxes on such commissions. So, you and I, we are all directors of our company, Maintain. Whenever our friends want certain taxes, such work done, we have our tax consultant, Jane. She's a CIMA qualified. We refer her, the people to them, to Jane, and Jane pays a commission to us for referring the clients. And that money, we don't show it in maintained books. we take it and we distribute it privately amongst ourselves and we don't pay the taxes also. Santosh is a celebrity in the music field and he's also a big investor in many business projects, and we have approached him to make an investment in our film Poverty Row to take a 40% stake in the Poverty Row finance. So remember there was another film on the pipeline, a film called Poverty Row. So we have got a very big man, Santosh, and he is prepared to, we have approached him to take the 40%. We are not refer Santosh to Jain, but we know he is a big time tax evader. Now, that may sound a little bit unethical to deal with a kind of a person who has that kind of a reputation. You remember we earlier in a scenario we saw we were dealing with a person called Stan, right? So that is gone now, that we can't bring it here. But you know, these are not the right things for us to do when we know he's a big time tax evader.
Okay.
I would like you to address the following issues and I need your reply as a matter of some urgency. Could we be accused of behaving unethically with respect to referring clients to Jain and earning commission? That's first part of it, right? What we do is we are directors of a company, listed company. We send our friends and Jain is our official tax consultant and we are sending our friends. She's paying us a commission and we take that one and keep it in our pocket without even paying taxes. Please response that we can submit to Frederica. Please also give an explanation for the board as how you will address the fact that the draft newspaper article clearly makes us appear unethical. We will consider your draft and related comments at tomorrow's board meeting before submitting anything. So let's look at what the paper article is all about. So this is what Eugene has got from Frederica Dance, the business recorder. Remember that's a paper in that country. And here he's writing, I'm seeking a response from Maintain concerning the proposed investment of celebrity Santosh. We have established evidence that Santosh has been investing heavily in many business and subsequently writing them off as losses to avoid paying tax on the considerable wealth that he has amassed from his show business career. We believe that so you remember they say they have enough evidence. We have established evidence. We believe that Santosh has been invited by Maintain to take 40% stake in Poverty Row and that you have referred him to your tax consultant to seek guidance on how to avoid taxes on this wealth.
Okay.
When researching this story, I posed as a potential investor and approached Jain, who is known to be specialized in offering tax avoidance advice to many business ventures in BLAC. So Jain is known to be very popularly known to be offering advice on tax avoidance. Right?
Okay.
So remember, there's something called tax evasion, there's something called tax avoidance. Tax avoidance is simply legal, maybe a little bit unethical, but it's simply legal. Tax evasion is illegal.
Legal, yeah.
Jain admitted that she has a large clientele of business entities where she offers tax avoidance schemes and specifically mentioned Maintain directors and also said that Maintain directors refer many of their friends to Jain for tax advice and said she makes a commission to Maintain for all these clients. So this lady went pretended to be an investor, had a chat with Jain, and Jain would have been really got boosted up. And Jain, in an outspoken way said, Maintain people are, I provide tax advice for Maintain people. They send their people, and I give them a commission also, most likely to promote herself. That's what they did. But this being a journalist, she would have recorded everything. Sufficient evidence to support every fact, and my draft article is ready for publication in next Monday's paper. Write in order to give Maintain the opportunity to respond if he wishes to do so, although the article will run regardless. So she says, whether we write or not, the article will go through. I will require your comments within 48 hours, otherwise I will write this story as it stands.
Okay.
So that's basically the scenario. So Now the first issue what we have to look at is, could we be accused behaving unethically with respect to referring clients to gain and earning commission? So we have to bring, whenever we are talking about ethics, we must bring the CIMA Code of Ethics.
CIMA Code of Conduct. Yeah, CIMA Code of Ethics. Yeah.
Yeah.
Right.
Mhm.
So basically, do we have to mention every code of ethic,
Not
or is
necessarily.
that only
Yeah,
or only the one which is
we
applicable?
can mention what is relevant here. What is
Okay.
relevant here. We don't need to go and describe the CIMA Code of Ethics. That is not, because in fact they are not, she are not asked about CIMA Code of Ethics. No? So we don't need to talk about all the Code of Ethics. We must talk about what is relevant.
What is
So,
relevant?
yeah.
Okay.
So what is relevant here will be the integrity, isn't it?
Integrity, yes, and professional behavior and duty as well.
Yeah, professional behavior is to a great extent, yeah, because we are supposed to be corporate citizens. We should be paying
Yeah.
taxes on whatever we earn, right?
Mm-hmm.
So by trying to keep that money without paying taxes, we have brought disrepute to the profession, to the corporate society. So to that extent, there's a professional behavior issue.
Okay.
Also, we have to be full of integrity. That means we have to be transparent. We have to be truthful in everything what we do, straightforward and honest. So there again, we appear to be somewhat not honest, particularly not declaring the income for income tax purposes. Referring clients, our friends to Jane is not an unethical thing.
Yeah.
She's a professional tax consultant. People coming to us, we don't ask, we don't get anything from them. We refer them, and even Jane paying a commission may not be unethical. It's a business. It's a business, right?
Right.
I give her a business and she pays me something, because there's nothing wrong in that one, because there is nothing fundamentally wrong with the action.
Okay.
Right? But getting money and not paying taxes is some problem. Even I don't think we need to include that in maintains, because we are not getting that in the form of maintain directors. We are getting it as some individuals. True enough, she is working for our company, or she is a consultant, but as individuals, our friends are referred. So because of that, I don't think there is any problem about it.
Okay.
Your friend comes and asks, hey, Veena, do you know anyone? I have some tax issues. I want to get it. Many of our friends. If we are referred many of our actors and cast, that would have been a problem, because in that case, it is arising out of maintain business context, and therefore that income should have been reflected in the maintain. Can you see the difference, right?
Yeah.
Your personal friends come in, you are a director of maintain, that's all right. So you will say, hey, our Jane is good, you go to her, and she gives a commission. Nothing wrong in it. So long as we declare and pay the taxes in individual capacity.
Right.
So simply to that extent, I think we have no problem. And also, so that's the first part of the question. Right? I would like to address, could we be accused in respect to referring client to an earning commission? So that part, I don't think we have an issue.
Yeah, but then
Yeah.
yeah, but then come on, like in that question, you also have the and word which says earning commissions, and we are not paying taxes on the commissions, right?
Yeah.
So basically, it is like a middle situation that like yeah, go on.
Yeah, basically not paying taxes, you may be even it may be illegal, it may be something that you are evading taxes, and that may be even you will be subject to penalties and fines.
Right.
Yeah. It's not only ethical issue, it's a legal issue also.
Okay.
Right? Not paying taxes.
Okay.
It's not a, but I don't think any other area there is a problem on ethical aspect in this scenario.
Right. Okay.
Now the second part, you remember, Frederica writes to us and Frederica says, we have referred Santosh to jail, which is not the case. So we can definitely deny that one. Say, very specifically we can say, we have not referred Santosh to jail at all.
Okay.
Right? So we can, because we are not referred to, so the paper articles are always trying to, put more than the truth. So we have to deny that one. Always it's a good thing, right? Then the other thing is about the conduct of Santosh. We believe Santosh will take 40%. We have to admit, yes, we have advised him to take 40%. That's all right. It's a truthful factor, right? And we are research I post as in then they are talking about established evidence. Santosh has been investing heavily in many things. Now that you do not know. We are not supposed to talk about other people's things.
Right.
We are not supposed. So we care to say we are unable to comment anything about what you mention about Santosh. As far as we are concerned, all what we are going to pay to the Santosh in form of dividends or whatever will be made transparent and will be available for public scrutiny.
Right.
We should not talk about Santosh's tax avoidance and things. We are as professional people, we should not talk about other people's things, about the hearsay.
Okay.
So that we can say. Of course, she says whatever you write, we are going to put in. So that's all right. But we will say we have to admit one thing, that we have been wrong in getting money and not paying taxes on that commission part of it. And we will say, we will have to say, we will include it in our next year's tax returns, and we will even include and pay the penalties.
Okay.
It's good to admit something. Whenever we do something wrong, it's good to admit the wrong thing and to accept it rather than trying to deny it. So that way, if you write, you probably will, even if she puts the article, she will have to put your response also, and the people will be much more we will be respecting you for accepting and admitting and doing. And also you will talk about Santosh and say, we are approached him. If we invest or in all our matters, we will ensure transparency being a listed company.
Okay.
That's all. There's nothing wrong in calling, because of course there's a little bit what they say about directors are aware. Right? So there's you remember in this case, please after response we can submit to Frederica. Please also give an explanation for the board how we will address the fact that clearly makes us appear unethical. So there's another task to it. One thing is to respond to the paper. When you are responding to the paper, we will just be very brief. Say we have not sent Santosh. We admit we have taken, our directors have earned some commission, but it was not reflected in our tax returns, which we will do it and pay the penalties. We regret very much. But as to the Santosh's conduct, we are unable to comment anything. We have invited, we accept, we have invited him, and if and when he invests, all transactions will be transparent, truly, and like a good public corporate, like a good corporate citizen, everything will be transparent and will be reflected in our books of accounts. That's all.
Okay.
Then you have to tell the board about the the fact that clearly makes us appear unethical. So we are unethical in, or maybe not even unethical, maybe illegal for earning the money. We may be unethical. We don't need to talk that to the press, but we have to be aware. Knowing Santosh is a big time tax evader, that you see, he's a big investor, and we have approached him to make, knowing that he's a tax evader. Avoider and evader is two different things. Knowing he's an
Right.
evader, by inviting him, we are making room for lot of criticism, and maybe we will be in line with unethical because our integrity is not right. That is to the board. We don't need to. We don't need to write about that part to the paper, because as far as the paper is concerned, he has not evaded tax for us so far. We are not supposed to comment about a third party anyway.
Okay.
So we have to be careful. If we have decided to comment, we would have been really, it's silly. And it's if you have commented on Santosh and saying that, we will investigate and all that, that is really crazy. We are no right to do that kind of thing. That's the kind of answer that you should be looking at. But you will advise the board in future, whenever we enter into such deals, to look at the background, credibility of the people, so that we get the right people, right choices, and we do that kind of a thing. So that's the kind of answer that you should be thinking of writing for this one, Navina.
Okay, sure, Kumar.
Okay. Right. So any other classes you're thinking?
Anything else we can, I can do to make sure that I...
When is the exam?
Exam is on 17th.
17th of February, no?
February, that is May, that's a Friday.
Yeah, that's a Friday. Yeah, what I can do is, I can send you a couple of mocks.
Okay.
In different areas. I'll see whether, because we covered up value chain, we covered up a scorecard. I'll see whether there are any other areas.
Kumar, there's one mock remaining which we haven't discussed, which is something relating to NEDs. You sent me one mock, but I couldn't write the answer. But I was thinking that we will discuss that as well.
All right. What is it?
The non-executive, the participation.
Yeah, we did not discuss that one. Yeah, we must discuss that one. Yes.
Yeah.
Commercial training. Yes, we did not discuss. No. Yes, we should.
No, we haven't discussed this.
Yeah, we must discuss that. Because here we have a couple of NEDs. This company, we must discuss that one. Sure. So we can have another lesson if you want.
Yeah. So after that lesson, like after discussing that NEDs one, is there anything else I would like you would recommend me to do as well?
We have done the consolidation. We have done. I think basically we have covered up many areas. But give me time. I'll just go through your class schedule and see whether there are any other areas that we need to cover up. I will maybe tomorrow, day after, I will go through the thing and see whether there is any particular area we need to cover up. I know NEDs we need to cover up a little bit. Yeah.
Okay. Yeah. Right. So fine. Okay. And what should I be doing now? Like how should I be approaching to my revision now? Because
what you can do is look at the mocks what we have done, right, and start writing. Even the NEDs one, you can with your knowledge you can start writing. All these areas, tax avoidance, all that you can start writing. I will also maybe today, tomorrow, I will send you some more marks for you to go through and to see whether you can pick up any more points and write now. Because although we have done some of these things, the questions that may come up may be not in any of these areas. It may be some other area.
Okay.
Yeah. So we do not know what the questions they will put it up for us. So because of that, it's good for us to now if you really look at some of the areas what they have questioned earlier is like pricing we discussed a little bit, I think. Yeah. So should ABC take over clients existing? Yeah. So outsourcing
Kumar, can we
is
discuss something? Yeah, can we discuss something on subsidiary as well? Like if I want to acquire a company or
yeah,
something like that?
that is also another area. We didn't do acquisition, no?
No, we haven't done any
Yeah.
acquisitions. So if you
Okay. So we
can
must,
cover one
yeah,
session on.
we must do an acquisition also. Sure. Yes. Yeah.
Yeah, so basically if we do that, obviously I'll have good hold on that part.
Correct. Yeah. I think we must do that one. Acquisition we should be
Hmm.
looking, and also key risk. Yeah, risk we did it, isn't it? Yeah, we risk.
Risk is what was the very first mark we
Yeah,
did. Yeah.
first we did. Yeah.
Hmm.
Evaluating performance also something that we may be looking at.
Performance, as in what performance measurement or
Yeah,
something like that.
key performance indicators, something like that.
Hmm. Yeah, we can.
Yeah. So some of these areas I just want to work through some area. So maybe we can look at the NED question next time
Hmm.
and audit,
Understood?
external audit.
Okay.
You remember these financial statements what we were having is
Hmm.
we had the financial statements for which period?
15, 16.
Yeah, that was the financial statements what we had. First December 2016. So we are in
Hmm.
February 2017. So there may be
Hmm.
some kind of a, you remember in these financial statements we saw some of the presentation itself was not properly right. There may be a
Hmm.
kind of a thing that auditors want to qualify the report if we present it in this form, and then,
Okay.
kind of asking what we should be doing.
Hmm.
So that may be another area that which we may want to do it. Modified audit
Hmm.
report, all that kind of a thing. Because this kind of a presentation, the auditors will not accept it. They might qualify the report. So how to persuade the auditors not to qualify, that may be a kind of a thing that we might want to look at.
Okay.
Yeah. So we have a few more areas to do it. Yeah, sure.
Hmm.
When
Okay.
are you?
So
Yeah.
when are we? Yeah, the same question. When are we
Yeah.
meeting the next?
Yes. When are you free, like?
Any day I'm free.
Yeah, yeah.
So what days you are available?
Yeah, say Friday, Saturday. Saturday I can do it in the morning hours if you are free, let's say around 11 o'clock or so.
Saturday morning hours, like what time? 10 or
11,
11?
11 o'clock, yeah.
Yep, sure. 11 is fine.
Yeah, shall we make it 11 Saturday?
Right. Yeah, that's fine. Kumar, we will need 2 more sessions or 3 more sessions for this one. The areas that we discussed.
I did three sessions because we have time, we are 17th is your exam, no? 2 sessions should be all right, I think.
2 sessions.
Yeah, so 11th we can do one,
Hmm.
and closer to the exam, say 17th is your exam, you said.
Yes, 17th.
14th or 15th we can do. Yeah,
14th or 15th.
14th or 15th we should be able to do something. 15th?
15th, what's the day?
Yeah.
15th, it is Wednesday
Wednesday.
again, yeah?
Yeah, Wednesday.
Mm, yes, fine.
Yeah. Wednesday, of course, I may have to do, normally we said 11 o'clock. Wednesday, I may have to do at about 10:30,
Okay.
if it is okay by
All right.
you. Yeah, Wednesday 10:30.
10:30.
Yeah, yeah.
Right. It's fine. Yeah.
So we had Saturday 11 o'clock and
11
Wednesday
o'clock
10:30.
Wednesday, 10:30.
Right?
Right. And also one more thing, Kumar.
Yeah.
Can we also discuss something on because the currency that the maintain uses is
$3.
dollar, right?
Yeah, yeah.
And the normal currency is euros in Europe. If it is
Yeah.
in Europe, the
Mm-hmm.
currency is Europe.
Mm-hmm.
So if the company is selling some films in outside the Europe or
Yeah.
outside any other country,
Yeah.
so the foreign exchange
Correct.
transactions.
Yeah, there will be foreign exchange transactions happening. So that IAS 21 will apply, where the transactions need to be recorded at the spot rate on the day of the transaction. And then when you get the money, you have to record it at the rate on that day. And then any difference arising should be taken into the P&L. We'll take that one now, sir. Can you send me a little mail of all what you think should be covered up? I will also think about it.
Right.
Just send me a mail so that I won't miss anything when we meet on the next two sessions.
Sure. Okay.
Yeah, right. So I'll see you on Saturday at 11 o'clock.
11 o'clock. No problem, Kumar.
Okay, Veena. Thank you. Take care.
Okay, Kumar.
Bye.
Take care. Have a
Bye.
nice day. Bye.
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 Bye.